There's one moment in the trading day when a huge share of all the buying and selling happens at once, not spread across the afternoon, packed into a single print at the close. In recent years, that one auction has grown to roughly a tenth of the entire day's volume, and most investors have no idea it's the moment that actually sets the price they'll quote tomorrow. Why has this one moment swollen so much? Follow the passive money. An index fund's job is to match a benchmark exactly. The benchmark is measured using official closing prices, so if the fund trades anywhere except the close, it risks drifting away from the very number it's paid to track. The safest place for trillions in index money to trade is there for the closing auction itself. That's the payoff to grasp early. The rise of passive investing didn't just change who owns stocks. It changed when they trade, and it crammed more and more of that trading into the final minutes. Now watch what happens on special days. On an ordinary session, the closing auction is around 10% of volume, but on the day the S&P indices rebalance, the close can swell to about 26% of the day's trading. On the annual Russell reconstitution, when the whole small and mid-cap universe gets reshuffled, the closing auction has averaged around 30% of volume. On those days, the last few minutes aren't part of the story. They're the story. Every fund tracking those indexes has to be holding the new members at the new weights at that exact closing price, so they all show up at the same door at the same second. So how does the auction actually work? In the minutes before the close, the exchange collects market-on-close orders, instructions to buy or sell whatever it takes to trade at the final price. Then it does something clever. It publishes the imbalance. It tells everyone in advance that there are, say, far more shares to buy than to sell at the current level. That published imbalance is a signal. It invites other traders, market makers, arbitrageurs, to supply the other side, because an imbalance means the closing price may have to move to clear. If buyers overwhelm sellers, the auction price ticks up until enough sellers appear. If sellers dominate, it ticks down. The whole system is a single, transparent, once-a-day negotiation to find a one price at which the most shares can change hands. The bigger the forced, price-insensitive flow going in, the more that final price can get nudged away from where the stock traded all afternoon. How much does this actually move prices? Studies of these imbalances find they shift the closing price by around 5.5 basis points on average. A small nudge on a normal name, but a real, systematic one, repeated every single day across thousands of stocks. And on rebalance days it can be far larger. The people on the other side aren't villains. They're providing the liquidity the forced buyers need. Why it means the official closing price, the number in every news report, every fund's books, every options settlement, is partly the output of a mechanical flow, not just the day's collective opinion. So here's the lens. The closing price you treat as the market's verdict is set in an auction that a huge, price-insensitive crowd is forced to attend. On most days, that barely matters. On rebalance days, it can dominate. The next time a stock jumps or drops sharply right at the bell on heavy volume, don't assume it's snooze. Ask whether it's the calendar, an index reshuffle emptying passive money into one print. That's not a signal to act on. It's a way to read the tape without being fooled by it. This channel explains how markets work. It's educational, not financial advice.